So I wanted to thank all of you for coming out today to we do this semi-annual, we do a couple luncheons. The purpose of this luncheon is to kind of look back at 2021, but you know what, it doesn't quite seem as relevant based on what's happened here the past couple months, so we'll definitely focus on that. Thank you for coming, we appreciate it. Thank you for those who logged into Zoom. Thank you, Ashley, for putting this together, and thank all of the WJ employees for coming and those that aren't here and participating. We really appreciate it. And then thank you for all being clients. We really appreciate your support over the years. Many of you, it's pretty amazing. I've looked around at the clients since, and 20 years, 23 years, that's a really long time. It's so long that I pulled up stocks, and fortunately, whatever your president said, it was positive. They're all green now. But it was so long ago that when I started, Bill and I started this business, I could actually read my phone when I looked at it. Now, unfortunately, I'm to the point where I might need assistance in doing that, which is really disappointing for me. Probably not for Wiley, not for many of you in here, though. You've been doing that for a while. Anyway, thank y'all for coming. We appreciate it. So yeah, a lot going on. I did want to spend a few minutes discussing performance last year and really the first 2 months, and then really wanted to focus more on what is happening now. And so we've got kind of a confluence of events which has created a situation that markets aren't reacting very positively to, whether that's the Fed, interest rates going up, inflation's an ongoing issue, and then of course the war, which has now been happening for a couple of weeks. I'm not sure if we're going to get to the last section. It would have been thrilling. Y'all would have found that to really be entertaining. It's kind of it's more of a detailed discussion of how we put portfolios together, and the idea was to try to tie together some of the things that we talked about the last luncheon that Brandon talked about, which was leverage and tail risk, and how we think about investing in a low return world and still trying to generate returns which are sufficient to meet all of your long-term goals, right? So the idea is we need to generate returns that beat inflation, which is obviously challenging in this environment. But over time, the key to investing is trying to meet those longer-term retirement goals and whatever goals that we've established in through Money Guide Pro. That's the means to an end. It's not the investment returns that matter; it's what they're for. So we may not get to that. I think I'd probably rather focus on your questions and the more timely things, and then actually going to write a white paper potentially on those issues, and maybe we'll do that at another luncheon. So we'll see as we go through this. So what we want to start with is just past recent performance. We're just going to go back to the beginning of 21. Here I show performance of the major asset classes, and these are asset classes or groups of stocks that we primarily invest in, right? And so these are going to be where most people invest. It was a great year last year for U.S. stocks. So U.S. large stocks, which is the S&P 500, had a fabulous year. Small stocks did well, also not quite as well. International developed stocks, just think of that as Europe and Japan, pretty good performance. Emerging market stocks struggled last year. Remember, emerging market stocks, 30% of them are China, and a lot of the Chinese stocks had issues. Xi Jinping, I guess, kind of expressed his authority and suggested that some of these companies and the leaders of the companies need to give back more to China and be less concerned about their own pocketbooks. And that dramatically impacted some of the largest stocks in the world, really. Alibaba, Tencent, very large companies that struggled pretty tremendously. In addition, there's even discussions of those stocks not listing in the US anymore. So that was a challenge for emerging markets, plus COVID, right? Remember, this is all COVID influenced in emerging markets. It's hard to know how China's dealing with COVID. I don't think they're real transparent about it. Terrible year last year for bonds. I say terrible because, the idea is bonds shouldn't lose money. They lost money last year. Cash, as usual, zero. Kind of getting used to that. And then just a global kind of balanced portfolio, which is typical for most of our clients. 60-40 was up 10%. That's a really good return. That's higher than historic numbers, higher than you might expect, and represents a good return, continuing multiple years of good returns. So now let's transition a little bit. And these are, a little bit dated, unfortunately. They're through 228, and I think just take those lines and extend them down a bit for each of these asset classes. But basically look at the reversal from last year, right? So the things that did very well last year are the things that are doing the worst this year. Large stocks, down at this point, actually down about 13%, maybe up a little bit today. Small stocks down, international stocks, developed stocks. At the end of February, we're down 7. Now they're down more than US because of the impact of the war, because of the challenges with commodities and oil. Emerging market stocks also collapsed over the past couple of weeks and are now down double digits, and now we're kind of in correction territory. But I want to focus on the bond. So that's in 2 months. Bonds have lost 3.4%. How does that happen? Remember that bonds move inverse to interest rates. So as interest rates go up, the value of current bonds go down because those bonds aren't as attractive. So we're in a position where you earn very little yield on bonds. Plus, if interest rates go up, you actually lose money. And that's happened pretty dramatically this year. So balanced portfolios this year are down because bonds and stocks are down. That's a bit unusual. Typically, you're going to see poor stock returns, but people move money into bonds for protection. But in a higher inflation environment, that offsets that potential negative correlation. So then cash, once again, 0, but then so a global 60-40 down 6%. Okay, and so that's quite a change from what we saw last year and really the past 3 years. And honestly, that type of return has been unusual for the past 12 or 13 years. Okay, so we just haven't seen much negative returns. We've certainly seen periods where we, like COVID, but I mean, that happened in like 6 weeks, we were down 35, and then 6 weeks later, we were right back up. So like the ongoing pain was pretty limited. This has actually dragged out more than COVID has dragged out. It's certainly not done. So I call this the path matters because, how you get to, like, from the start to the end matters. It's fine to say, like, there was, you could say, hey, stocks, return whatever, 40% over that period, but you did have a point where you were down 25. And so the idea in investing is, you want to be in a position where you don't panic on those down markets to hold on for the recovery. And bonds, the other thing I wanted to point out there is the red line. So basically over this period, like pre-COVID through the end of February, negative, lost money in bonds, once again, because of rising interest rates. A little bit hard to see, but I think the key to this is that what we're looking at, you all maybe are familiar with the periodic table. We've used this before. It's kind of my favorite way to present asset class returns. I think I'll start with this by looking at the black square. So the black square is a balanced portfolio. The key to diversification is you don't get the worst return with a diversified portfolio, but you don't get the best, but it's somewhere in the middle. That's persisted, obviously, last year in 21, where the balanced portfolio, in this circumstance, the way we measured it, was up 12. A balanced portfolio is not the worst portfolio this year. And over time, you can see it's actually second from the top, which I find interesting in that it beat most of the other asset classes. The other thing I wanted to point out in this periodic table is that the red and the yellow are our primary diversifying asset classes. So that's going to be trend following strategies, which can bet on currencies and commodities and stocks and bonds, either up or down. And then reinsurance. And reinsurance over the past 3 or 4 years has struggled. Up a little bit this year. We just haven't had any events. And in comparison to the market, it's done what we hoped. You'll note that 3% in trend following, that was through the end of February. As of yesterday, that number's 10%. And here's the reason. They own a lot of commodities. And you may have seen what happened in oil and nickel and natural gas and wheat. All those things skyrocketed to the point where it's causing now issues in the financial system where people are overexposed or underhedged or getting margin calls. We're long those commodities, and that's what those strategies do. It's also been a very good inflation hedge in that the red was up last year and the previous year. So those have been good diversifiers, but they've benefited a lot from rising commodity prices. So when we talk about inflation, keep in mind that red area, the trend following, is part of our inflation hedge, right? They've also been betting against bonds. And then the other thing I'll point out is that U.S. stocks, which were the best for the last 3 years, were extremely good are the worst performing so far this year through 28th, through the end of February the 28th. So also finally, 5-year returns have been 8%. You know, we've been talking about low returns for a while. That's not a low return. That's pretty darn good on a balanced portfolio. Probably definitely wouldn't expect that on a go-forward basis. It's been really good with stock returns, been exceptional. And remember, this is all with the background of COVID. I mean, I don't know if, I doubt, no one would have predicted that we'd see those types of stock market returns if I explained COVID to them. It wouldn't have happened. We'll talk a little about inflation and some of the reasons, but that's pretty remarkable considering what we are still going through. It's not complete yet. Okay, so that's kind of the background on markets. I want to talk a little bit about kind of the current situation, what we're seeing in markets. We'll talk about the war. We'll talk about favorite topic, inflation. So this just shows year over year inflation. You can see over to the far right, inflation's running 6 or 7%. This is not like everything is up, but used cars are particularly, prices have gone through the roof. Definitely oil, and that's accelerated here recently. Food, I hear a lot of people complain about meat prices. So it's not necessarily equal across the whole universe of goods that we buy, but definitely inflation's an issue. We wrote about this in the last WJ notes. I mean, our view is this is due to COVID, right? So the government's reaction to COVID was to spend $5 trillion, and basically a lot of that money was just sent out to people. People were stuck at home, so what did they do? They got on Amazon and they bought stuff, right? And they ordered a lot of stuff that they typically wouldn't have bought without COVID. In addition, if you're a supplier of goods, your employees may not be available to make the goods. There are not ships to ship the goods. The logistics of even when they get to the US, how they get to the end consumer aren't available. So you combine the two things, and essentially COVID's created a situation where we have inflation, and it's pretty significant. We feel like it is transitory. I know that's become a negative term because it's kind of a supply shock issue that we're going through. The demand portion of the government spending is going away, and eventually the supply issues will be worked through. Now the thing is, this is now being exacerbated by the war, right? By the lack of access to natural gas, to energy, to other commodities and prices. So it's going to be an ongoing issue. But look, the Fed's job, Federal Reserve of the US job, and every other central bank is to fight inflation, okay? So when they see this number, they are supposed to react and do something about it, right? They're supposed to make sure that inflation's not an issue. Their target for inflation is 2%, and anytime it's above 2%, they're supposed to react and do something. And you can see, going back to the 90s, it approximately ran at about 2%, right? That's the type of inflation that they find desirable. So what did the Federal Reserve start talking about at the end of last year and have talked about this year? We're going to increase rates, right? So we're going to increase shorter term rates with the hope that somehow controls inflation. A lot of debate whether it will or not. If it's a supply shock, I'm not sure if raising rates necessarily is going to directly address the problem. But this is how they know how to fight inflation. This is how they did it in the 80s. This is how they've done it in the past. So lots of discussions about how many rate hikes this year, whether it's 5, whether it's 7. These were all kind of the beginning of February. And probably based on the war and everything else, they're not going to be raising that much, but they likely will be raising rates. Raising rates is bad for real estate. It's bad for certain investments that are dependent on low interest rates. It's also signaling a change in position from a very accommodative policy to a much more restrictive monetary policy. And a lot of people make the argument that stocks and risky assets have done well because of an accommodative policy. Well, now that's going away, right? So whatever the backdrop was for stocks to do well or other risk assets to do well is going away. So look, this was before the war. This was coming, and markets started to react to this at the beginning of the year. So we've seen stocks and bonds struggle this year based on this. Not anything to do with the war. That's just caused additional issues. There's some other things going on underneath the surface that I wanted to point out. There's been, and we've written about this too, we've actually written about the last couple of years, but there was a huge, I'll call it a bubble because I think it's pretty apparent it was, in kind of these new technology innovation stocks. So stocks that really have no earnings, but they have a really cool product. Okay, so call it like a Docusign, a Zoom, for example. Like Zoom's a cool product, we all use it. Another example, we're going to look at these in a second, but Peloton, I mean, it just goes on and on. A lot of these companies, some of them have reasonable products and make money, a lot of them don't. Tesla's maybe another example. ARK, a fund run by a woman named Kathy Wood, buys all those stocks. That's all she buys. And her fund from the bottom of COVID till the top in February was up 365%. In addition, her fund over the past 5 years was up 55% a year. What happens when funds are up that much? There's a lot of people who dump money into them trying to get those types of returns, right? And then what else happens? Well, usually their timing is impeccably bad, right? As it was in this case. And so that fund, although this chart was through the end of February, is actually now back to where it was prior to COVID. So it's actually lost all of the gains during COVID. To me, that's a bubble, right? Now, the thing is, we try as much as possible to avoid bubbles. We never owned ARK. There were a lot of people who did, apparently, over 50 billion, who are now down approximately 70%. So this is going on underneath kind of the primary stock indexes because they are only down about 10% when these types of stocks are down even more. So I highlighted a few, I've mentioned some of them. This is just a chart of some of the ones that Kathy owns and some of the ones that got way overpriced. Robinhood, you probably heard of the broker, right? Down 86%. I mentioned Peloton. I mean, Peloton is a cool product. I'm sure many of you have one, but they're not really a technology company. And guess what? COVID, they benefited tremendously. Everyone bought Pelotons. Well, they're not buying them as much now. So how many Pelotons are going to end up being a hanger rack? Like most of the, come on now, everybody has one of those exercise bikes, right? I mean, that's what happens to them, treadmills. Down 80%. And this is a bit dated too, it's probably even worse. I mentioned the next one because that was the hot meme stock, AMC down 75%. So everyone bought AMC, made a bunch of money. It's been destroyed. Zoom, I find this one fascinating. Even Brandon sent me something the other day. He's like, Zoom's down like 70%. So this was COVID, right? Everybody's on Zoom. I mean, probably everyone in this room, you thought you might not be on Zoom, but you've done at least one Zoom. So that stock's down 70%. Now its revenue from COVID is up 4 times, but the stock got so wildly overvalued that it's been destroyed. I'll mention Upstart because I'm going to mention it on the next slide too. So remember that one, down 67. And then finally, Brandon and I were talking about this one. So this is Docusign. So Docusign makes a great product. Like, I don't know anybody here in real estate. I mean, like everything goes through Docusign and it's fabulous. We use it for Schwab. We use it. I mean, every industry is eventually going to move towards Docusign or something similar, and they make a lot of money. But the stock's down 66%, right? So this is an example of a fabulous story and really a very good company that got wildly overvalued that investors got too excited about, okay? And remember, there's a difference between a business and a stock. And you can see that in a lot of cases, people got too excited about the business and forgot that the stock can be way overpriced. So the reason this is important is because in the past, when you've seen corrections like this in certain market areas, it's moved over to the market as a whole, right? We saw this in the tech bubble. Tech stocks crashed, and eventually it dragged down the S&P 50%, right? So we're watching this closely. We've been speculating as to whether stocks can lose 80, 90% and it not impact the overall market at some point. So far, we've held up, but we'll see if that continues. So let's talk a little bit about bonds. I've had many, many discussions, as has Brandon and Jonathan, about bonds. We've written about it extensively. Yields are still, even though they're up a little bit, at pretty much all-time lows. The best prediction for bond returns over the next 10 years is the 10-year yield, which today is at 1.9%. So you're likely to earn 1.9% on that bond over the next 10 years. Inflation is likely to run probably 2, if not more, right? So you're going to lose money in real terms on bonds. On the other hand, we own bonds for a reason. Even though they're down and returns look pretty dismal, they don't fall like stocks do when stocks go down. So they provide the offset, the protection, their diversification, right? So we're forced to do a couple things in terms of putting portfolios together. One is maybe find some alternatives to bonds. Remember reinsurance and trend following, which I showed you earlier. But two is like we can own, there's a huge amount of different bonds that you can own, okay? And on the left, so I show from 1/1/21, so January all the way through the end of February, US bonds, which are going to be corporate bonds and treasury bonds and municipal bonds, kind of the typical bonds that most people buy, are down 3.6%. The thing about bonds that matter in terms of returns, though, is how long the maturity of the bond is, right? So if I buy a bond and it matures in 3 months and interest rates change, it doesn't really change the value of that bond much. In fact, when the bond matures, if interest rates go up, I can just roll it into a new one. But what if I own a 30-year bond and interest rates go up? I'm stuck holding that bond for 30 years till I get my principal back. The value of that bond drops a lot more than the shorter term bonds. So once again, there's this inverse relationship. So cash and short term bonds didn't decline or declined very slightly, whereas long bonds, in this case, we're talking about something that's about 12 years maturity, fell 9%. If I showed you a 30-year bond, it fell probably 25%. So in thinking about managing a portfolio, we can decide what the maturity is of the bonds that we own. We don't have to own long-term bonds. We can own short-term bonds. In addition, the other thing that drives bond returns is credit risk, right? So the US government, every time I say this, people laugh, but the US government is the safest investment out there. They will return your money eventually. People shake their heads too. But look, they may have to inflate their way out of it to get the money back to you, but they're the safest investment. So there's no risk that they default. Everything else in the world has risk that it defaults. The UK, maybe not so much, but think about Russian bonds. I mean, what would you require now to own a Russian bond? What kind of yield? I mean, the market is saying right now it's like 187%, right? Because the assumption is you're not getting your money back. But what about a Apple bond? Well, look, you wouldn't be paid much to own an Apple bond. It's pretty safe. On the other hand, we'll think about like a Royal Caribbean, like the cruise line. You probably demand a lot more. So we have control over that too. We can find managers who buy higher risk bonds. We can find managers that buy lower risk bonds. And what I wanted to show you is the actual performance of the funds that we owned over that period. And what you'll notice is that the performance is dramatically, in some cases dramatically, but definitely different and better than kind of that general bond index. So we owned a lot of shorter maturity bonds. So like an FPA New Income is short maturity bonds. Baird Strategic Municipal is shorter bonds. And so they both, around the corner there, they both made money. And then in certain cases, we owned funds that took more credit risk, whether that's in mortgages or commercial loans or that kind of thing. That's double line. And then you'll notice kind of the outliers, that Stone Ridge Alt Lending Fund. So the fund itself, the strategy is to make personal loans to people. You know, the typical loans maybe 10 grand. They charge on average 14%. They own tens of thousands of loans. That strategy in and of itself over this period was probably up 10. But in addition, they owned a stock called Upstart, which we looked at earlier. And they own that stock because they got it before it went public when they started the fund. Unfortunately, it went public and went up about 500%. They sold it, right? And then you saw what happened to the stock. So their timing was impeccable, not because they knew what they were doing with it. It's just that they had to hold it 6 months and get out. So that was a strong contributor too. So anyway, the point here is that you're not doomed to the negative returns in bonds or even the very poor returns in bonds. Positioning the portfolio such that you have the duration correct and potentially the credit risk correct can mean that your bond portfolio can do okay. And so we spend a lot of time on thinking about the funds that we own and the weightings that we have in each one. The challenge in this obviously is if interest rates go down, right? So if they go the other direction, which usually happens when people really panic, okay? then the short maturity bonds do worse than the long maturity bonds, right? So the cash stays at zero and long bonds actually make money. So you're constantly adjusting portfolios to reflect the current environment, and we do. Okay, so let's talk about the war. I have a couple slides here. I think the first one we put together, this was from Vanguard, and basically what they looked at was the kind of initial reaction to a geopolitical event, right? So, we can look at, interestingly, look at 2014, the first Ukraine conflict, which I guess was a warning about what was to come that maybe we ignored, but there it is. Brexit vote, you can look at the hostage crisis, et cetera. So you can see the initial reactions are not really that dramatic, right? 4 or 5%. This is the stock market. And then look 6 months later and 1 year later. In general, you wouldn't know anything happened, okay? And I think for a lot of geopolitical events, that is the case. I read I'll just make this point because I thought it was interesting. I read an analysis the other day from a company called BCA. It's Bank Credit Research Analysis, something like that. Basically, they said, look, we like stocks here. If it's the end of the world, it doesn't really matter, right? Okay, so it's basically true, right? So like, I'm not showing you the thermonuclear war like result of the stock market because it doesn't really matter. We have to think that that type of outcome doesn't happen. And we have to think that in most cases, these geopolitical events fade to the background and cooler heads prevail, and whatever happens, we move on to the next one, which will probably happen in the next few years. So like that particular event didn't, and knowing like it was a surprise that the market reacted, we didn't react to that. We didn't make any changes to portfolios. We didn't adjust portfolios on that basis. But what matters really, I think, for y'all as investors and for us as money managers is the next chart. And what we're showing here is what happened, the percentage change from February 1st, so when Ukraine was invaded. So the light line there is wheat on the left side, and the other one is corn. So as it turns out that, between the Ukraine and Russia, I think it's like 40% of the wheat market. So that's, think about a supply chain disruption. You got a huge one right there, and prices skyrocketed. And wheat trades, these are all futures contracts. You can't necessarily trade like the spot price. But anyway, wheat for the last 5 days has been, it can only go up a certain amount each day, and it's been limit up. And then corn, similar thing, not as much of an issue. But nickel's an interesting one. So nickel, which I think basically for 50 years has never traded more than a few pennies one way or the other, was up like 150% the last 2 days. Nickel is a large, they put it into batteries. Okay, so they put it into Tesla batteries and EV batteries and that kind of stuff, and it's strong demand. A lot of it comes from Russia. And then finally, we know gas, right? So gas and natural gas. Russia supplies, I think, 40% of Europe's gas. Okay, and when we buy oil from Russia, like 1 million barrels a day, something like that. Like I think 8% purchased. President just said we're not going to be doing that anymore. And I guess he's taking steps to try to get additional oil pumped by Iran and Venezuela. Seems like strange choices, but I guess you go where the oil is, and apparently they have some capacity to pump more. I saw the gentleman that runs Hess, which is an oil exploration and natural gas company, this morning, and he said, yeah, we have the capacity to pump more, but it doesn't happen overnight. We'll do it, but in addition, we want a few reassurances that if we go spend a bunch of capital, that we're gonna, the game's not gonna change after we do it later, right? So, maybe some discussion between the politicians and the oil and exploration companies would make sense. Pretty much what we've seen, as you know, is that oil prices went from literally negative back in COVID to the highest they've ever been, okay? So, but oil companies in general haven't taken that signal to be like, hey, we need to go out and explore more. They're basically taking that money and sending it back to shareholders because they're concerned about the future, right? And they're not gonna go spend billions of dollars to do speculative investment based on something that could change. The rules could change dramatically within a very short-term period. So we're kind of stuck. We're in better shape than Germany, which counts on a lot of their oil imports and natural gas. Natural gas, I guess, primarily from Russia. And I don't think they have said so far that they would end natural gas imports, but Russia threatened yesterday to stop exporting natural gas. Natural gas already in Europe, just to give you a sense, is like whatever they measure it in, $5. It's $5 here, it's $100 over there. Let's just put it that way. It's 20 times higher. The equivalent kind of price for natural gas in terms of a barrel of oil in Europe is like $600 a barrel. So they have huge issues. They are very dependent on natural gas and oil from Russia, right? And Russia controls that card pretty dramatically. So look, I think that's the potential influence. So then let's step back and think of it from an investment perspective. Oil filters through to inflation, right? I mean, it's a primary component. Like, so if we fly, if we drive, there's a lot of components to this that it influences. The Fed is already in a position where inflation is higher than they want. They're raising rates to try to control inflation. Now you throw this in, it's just going to make inflation worse. And how long this lasts, nobody knows, right? This could go on for months. It could go on for years. The influence on it could go on on prices could go on for a very long time. So it makes the Fed's decisions even more difficult and tougher. And I think that's going to be a challenge. In addition, when commodity prices go up, in fact, take this chart and I'll explain it, but add in oil prices. So the blue line represents the difference between a 2-year treasury and a 10-year treasury. So keep in mind that, like, when you own something if somebody says, I'll loan you money for 10 years, you're going to demand more in interest than loan money for 2 years, right? Because you're not sure you're going to get it back. So say for the 10-year, you demand 3%, and for the 2-year, you demand 2%. So the difference between the two is 1. So what the blue line represents is the difference between the two. And what happens is these prices move differently. And when the Fed starts to raise rates, typically the short rate goes up and the long rate stays down or stays flat and actually goes negative. So you can see the negative is when it's below 0. Well, what's happened every time that it's gone negative? The red represents recessions. We've gone into a recession. Okay, and whether that's Fed induced or, interestingly, the COVID thing, I guess it went negative very slightly. Certainly the market didn't predict COVID, but the point is, when it goes negative, it's just another precondition typically for a recession to occur. In addition, every time oil has gone over $100 a barrel, we've had a recession. That was 2008, it got to 140. It's happened, obviously, in the 70s, it's happened. So you're setting up a situation where the Fed is going to start raising rates. That's going to cause this 2 and 10 to start to slope down. Oil prices are already, and gas prices are already through the roof. The Fed's going to need to be very careful about how much they raise rates and be very nimble in case they need to stop, right? Or we're going to have a recession. Stocks outside of a recession, falling 20% happens, but usually you recover it pretty quickly. Whereas stocks during recessions fall more, right? And the recovery can be much longer. And so the stock market declines in 2008, which were 60%, or 2000, or even going back to the 90s, the stock market declines were definitely more than 20. And those are just much more significant and serious. And I think to some degree, look, markets already were trying to adjust to raising rates and the influence that would have on economic growth long term. Now you throw in oil, makes it even more of a challenge to figure out. And then, the Fed still has said they're going to raise rates. So those combined together creates an environment where stocks may not do well and we may have a recession. And the market is just trying to figure that out now, right? I mean, that's basically the environment that we sit in. I'll just say one final thing about that is that historically, at least, when we go into a recession, the Fed has the ability to cut rates to try to stimulate the economy, right, to offset the impact of it. But they're stuck this time because they're trying to fight inflation. They can't turn around and say, oh, we're not going to increase rates, we're going to cut rates, because then somebody's going to say, well, what about inflation? So they're kind of stuck between a rock and a hard place in terms of their policy. And I think that's going to be a huge challenge to see how that plays out over the next 6 months or a year, along with the complete wild card of the war and the final outcome to that and how it influences commodities and other things. So I'm going to stop there, see where we are. So 12:32. I think before, like I said, we move on to the next session, what we wanted to do is maybe Brandon and Jonathan, y'all could come up and then we'll answer a few questions. I'll just point out also that Brandon just published, it was this morning, right? A blog on the Russian war. And maybe, if you don't mind, maybe you could just spend a few minutes kind of summarizing what you found.
How you doing? So the blog today, really what it was going over is more or less just a recap of what's happened over the last 2 weeks, because I know there's a ton of news coming in every single day. It's evolving every single day. I mean, things that I put in the blog that were published this morning are already starting to change. Interest rates are changing. Oils, obviously, we're not buying oil from Russia anymore, so it's constantly evolving. But the first section of it really just kind of reviews the sanctions that we put on Russia and just how devastating they actually are. And the biggest of those would be all of the central banks from Europe and the US no longer banning transactions from Russia's central bank. And this might not mean a lot, but it's absolutely devastating because Putin, over the years preparing to make this invasion, has been developing sort of a war chest. Many of you have probably heard about this. It's about $630 billion worth of reserves that he would be able to use in case we eventually put on sanctions against their government, which he knew we were going to do. We've already had sanctions. We just have more now. Well, the thing is, whenever you have reserves in your central bank, those reserves aren't just held in one spot in your own bank. They're kind of spread all over the world. And they're essentially in cash, but kind of like when you put your money in Schwab and it gets swept into a cash fund, basically, and when you want your money back, there is technically a transaction there that has to happen where that money gets converted into actual cash and sent back. Well, if you ban transactions, all that money is essentially locked up. So that $630 billion that he thought he had there, about 2/3 of it was held in reserves outside of Russia's central bank. So it's no longer available to him. In addition, another 20% is held in gold, which he does hold in Russia. And that gold can be sold. But of course, it's not as liquid, right? You got to find somebody who wants to buy that gold. You got to settle on a price, things like that. And then you actually have to deliver it out. So it does make it difficult. So that can kind of, that one sanction, more than really any of the others, in my opinion at least, has really crippled some of his plans going into it. It talks about a few more of the sanctions that have happened. It talks about some of the private company response. So you guys probably heard, like Disney Plus isn't streaming their movies over there. Maybe that's not super devastating. Different social media companies, but more important things like MasterCard, Visa, Amex, BP, Oil, Shell, Exxon, GM, Ford. I mean, the list really goes on. All these private companies are removing investment from Russia. They're removing operations from Russia. And possibly that could all be reversed if things ever get resolved. But if Putin stays in power for longer, potentially it doesn't go back. So that's definitely puts a big strain on the Russian people. And then finally, the result of those sanctions, the Russian ruble, which is their currency, has absolutely collapsed. It went down about 30% in one day. It's been going down for years, and this has just really accelerated it. And I was reading an article from Reuters about just some of the experiences of the actual Russian people. And for example, a guy says, I was looking at a watch that was 40,000 rubles. I came back the next week, it was 100,000 rubles. And that scenario is playing out everywhere. You go to the grocery store, whatever you wanted a week ago, it's now costs 2 to 3 times as much. So, that's just interest rates have doubled and tripled in many cases. So if you were going to go buy a house, I don't know what mortgage rates are in Russia, maybe 6-7%. It's probably higher than here, but they're double or triple now. That devastates the housing market. So the knock-on effects, and not to mention the markets, their actual stock market's down 80%. So crippling sanctions, devastated economy. I would hope that, the Russian peoples are hurt enough that they can bring any sort of pressure to get Putin to change, what he's doing. I don't know if that really is a factor in Putin's mind. I really have no idea. But that's essentially the long summary of the article. Actually, I pretty much told it to you, so you don't have to read it anymore.
Inflation. Yeah, so I think when people talk about inflation, there's some contention that inflation. Oh, I'm sorry. He asked about government spending, and how that influences inflation and what the ultimate impact of that is. And so, yeah, I think longer term, one of the ways that governments get themselves out of debt situations is just to print money. So just think of it simply like if you owe someone $100 and you can print $100, you just print it and give it to them. Okay, and we've seen that historically. We saw that in the Weimar Republic. We saw that in Zimbabwe. They inflate their way out of the debt, right? In addition, if you owe money and inflation is 5% a year, then the amount that you're paying out is a little bit lower each year. So it doesn't have to be like hyperinflation. It's just easier to pay back debt. And so the concern is that that's the way that the U.S. is going. And no doubt, we spent $5 trillion that we did not have. Basically, the government issued debt to get the $5 trillion, and then the Federal Reserve turned around and bought that debt. That in and of itself is not the same as printing money and giving it out, right? It's basically just flipping longer term debt into shorter term instruments. And in our view, like the main influence that has is people are then stuck with cash that yields nothing, and in fact is negative, and they need something to do with it. They don't want to hold it. Well, what do? They go buy stocks, or they go buy real estate, or they go buy everything, and it drives the price of everything up, right? And lowers future returns. The thing you would need to be concerned about, like if the government prints money and starts to send it to you directly, then that's definitely inflationary and be concerning. The question really is, when do we get to the point where maybe investors demand more interest in order to cover the concerns about inflation? When do we get to the point where that overall level is just too much? I'll say if you look at Japan, they've been doing the same thing we're doing for 30 years now, and they cannot generate any inflation. Their debt levels are much higher. So no one knows the answer to that. I wish there's no way to know when that level comes. And I think the problem with it is betting or developing an investment strategy on that basis. You literally could be wrong for 20 years, right? And the opportunity cost is too large. But that's definitely part of the internal debate. I wrote a little bit about it in the WJ notes. You wrote about it in your inflation paper. You have to, is it a supply shock issue or is it government debt or something else? And we'll see. Other questions? Yes, sir. No. So the question was about the prices of goods. We may see inflation, so the rise in prices, but do you see prices coming back down? No. So inflation is just a measure of the change in price. The price level's there and typically doesn't come back down, right? Now that's what's so hard to measure. Like I don't, if 2 years from now I buy the same TV that I just bought, 75-inch TV, and it costs half as much, is that deflationary, or is it based on like the quality of it's better or whatever? So it's hard to measure, but typically prices don't come back down. If you're running a company and inflation dissipates, would you then say, well, I'll just cut prices to be supportive? No, you wouldn't. And in fact, this is completely true that some companies have raised prices because they could, okay? Because everyone else is doing it. And the reason I say that that's true is if you look at profit margins, I don't have the chart, but they're as high as they've ever been. Okay, so this is prices going up, and yes, costs are going up, but prices are going up faster. And so if you're running a company, my guess would be you just stick with where it is. On the other hand, commodity-based businesses, so like an airline who has to be competitive, and then maybe they raise prices to cover higher energy costs. As energy costs come back down, I guess they would lower it. But I don't see, and I think there was some confusion about that because I think transitory I think some people interpreted maybe as like price levels going up and then coming back down. And he didn't really say that. He was just saying like the idea that inflation is 2 and then it's 10, it's going to come back to 2. On the good side, that's correct. I mean, but even on the services side, so look, the goods were the main impact of inflation. We have a chart somewhere that shows goods versus services, but services are going up too because you can't go to a restaurant and they all need help. One way you can get someone to go back to a restaurant is to pay more, or a hotel or whatever. And we speculated a lot, and I've never really seen a good answer as to where all the people went, but they lost their jobs in the hotels and the restaurants. Maybe they drive for Amazon now or something, but all those jobs were gone and the people don't seem to be coming back. And maybe they hated the job in the first place and they don't want to come back, but they're doing something because unemployment itself is pretty low, right? So the overall economic conditions are pretty good. Other questions?
How are you adjusting the portfolio to current conditions?
Yeah, so one of the things we did, we're doing nothing right now, Jeff, but the question was, how are we adjusting the portfolio, or how are we positioning? The beginning of the year I think I've mentioned this before, we mentioned it in some of our writings. Mutual funds made a large amount of distributions last year, so they have to pay out capital gains, and after 3 years of really good markets, they had to pay out capital gains. So what we usually do is accumulate cash through the end of the year and get into January and then invest that cash. You don't want to invest the cash like in December because you may turn around and get it back as a distribution. So when we invested that cash, we bought more managed futures, which was the investment which we knew was a pretty good inflation hedge. So I think we increased that weighting like 50%, recognizing that those funds would do really well in this environment. So and you look back historically, they were fabulous investments when inflation was high. They weren't so good when inflation was low, which is the previous 10-year. So that's one thing we did. We also just raised some cash. So the stock market was higher, right? And so you'll see a fund called Vanguard Short-Term Treasury or something. It's a couple % position. We actually raised cash thinking that, stock prices had done incredibly well, thinking that stimulus from the government was dissipating, right? Going away, which ought to maybe slow economic growth. So those are the recent changes that we made. The other thing that we've been working on, and I alluded to it earlier, and we talked about it last year, is this idea of using leverage and tail risk, and we're still implementing kind of those changes. At this point, it's interesting. So probably personally, we haven't discussed this as a firm, but look, oil prices are through the roof, commodity prices are through the roof. Now I think everybody's piling in. Now this is not a secret. Now it's a big deal. Maybe the time to start pulling some money off the table, right? Looking at like taking some profits out of that area. And I don't know how we would implement this, but I showed you the devastation in those types of stocks. Some of those stocks are going to do fabulous. I don't know anyone that could pick them, unfortunately. Kathy Wood can't pick them. She just bought all of them and assumed they'd all do fine, and didn't work out. But some of those stocks are going to do great. So there may be some opportunities like there. So. And the other thing, of course, that we always do is rebalance portfolios, which we have not done yet. Markets have gone down, maybe kind of 13, 14%. They would need to go down probably another 10 before we would actively rebalance. And that would be an opportunity to sell some of the managed futures and commodities and then shift money and use some of that cash too to shift money back into stocks. I will say that when we put together portfolios, we try to think about a negative inflation, like a deflation environment. We try to think about a high inflation environment. We try to think of all environments and think about portfolios that work pretty well in all those environments, okay? Because honestly, no one knows when, it's hard to even judge what environment you're in, but like what environment you're going to go into. So like the idea of like an all-weather portfolio is what we're striving towards, which just means that when inflation comes, we don't have to take dramatic action to adjust the portfolio completely. If you were sitting here in an inflation environment and you owned a bunch of 30-year treasuries, your bond portfolio would have been down 40% last year. And that might have been a good strategy when deflation was coming, right? When interest rates were going to go down. But if they're going to go the other direction, that's not how you want to be positioned. Well, we never were positioned that way in the first place. We really try to think about different environments and try to own funds that can do well. So if you didn't own commodities, that would have been a purchase for any portfolio manager, I don't know, like a year, 18 months ago. I mean, you would want to own some knowing that those tend to do well in inflation, not even knowing about the war, but just recognizing that supply chain issues and other things were going to cause commodities to do well. And fortunately, we own them, which is one of the things that we liked about the trend following kind of managed futures, is they can own them. They can go long, but they can also bet against them. Yes, sir, Mr. Reed. Yep. Yep. They are. Yep. Yeah. So the question was about short-term bond funds. So remember I showed you cash, which is 0, but if you have any duration, right? So a long-term bond may lose 10, but yeah, as you move this direction, they start to lose money. So even short-term bond funds and bonds have lost money. It is the case that if you hold them to maturity, you get your principal back, right? And then you can roll them into higher yields. So I mean, honestly, there's not a lot you can do right now because part of the problem is that rates have not, well, I guess market rates have gone up, right? So we've seen a bit of an increase. So the fact that rates are going up, that ought to offset these capital losses. It just hasn't happened yet. It's been a really unusual period. You have to go back pretty far to see those types of losses in bonds, even short-term bonds. I mean, the answer to that is you probably even wanted to be shorter term and put it in cash, right? Put in cash, then you're not going to see any interest rate change. The problem with all that is like you're talking about like 0% to 1 to 2 when inflation's running 8. So your real return on all that stuff is like last year was really atrocious. And now what we're seeing is if I look at stock returns over the past year, it's about 3%. So on a real basis, that's not attractive either. It's a challenge. Like cash for sure it's always been a challenge at 0, but now with rates, with inflation where it is, it's even more of a challenge. I think there's another question. Yes, sir, Mike. Yes. Yeah, so I mean that number actually comes. It comes from the fact that at that point, the weighting of stocks within portfolios is 2.5 to 3% under what it should be, right? So that's more of the trigger, but it happens to be at about 20%. So that just means that bonds and other things have gone up and they're overweight 3.5, and stocks have gone down and they're underweight. And then kind of we use that as the trigger because that's sufficient enough to make sense to do the trades, right, to justify it. It also is sufficient enough so that if you do it and the day you do it, markets go up 10%, which has happened to us, it still makes sense, right? The other thing is, look, I'll just put it simply, like if markets are going straight down that day, we're not going to do anything. I mean, you're just not going to buy, like catch the falling knife analogy, you're not going to buy into that. So you're going to wait for a bit of stability. We tend not to like to get into thinking like, oh, I don't know, this, the war thing could change tomorrow, or like, it's more mechanical, non-emotional, that we've been successful in doing that, as opposed to trying to like decide whether it's the right time to do it. Recognizing though, when you do it, like you may be doing it again in a couple of weeks if prices, continue to fall and go down. What would you say anything else about rebalancing, Brandon?
No, I mean, the only thing I'll add to that is that's kind of isolating stocks. So if stocks go down 20%, we make a move. I mean, it can come from somewhere else as well. If bonds rally, for example, and they become overweight faster than we expected, or if managed futures and just alternatives in general continue to outperform by a high clip and just the weights get way off, or we feel like commodities that play has really been overextended or something like that, that trade can come from a different area than just stocks alone. But certainly stocks is the most important one since it's the biggest weight in everyone's portfolio.
Right. Yeah. Good question. And we have, first of all, we talked to a lot of clients about that. We actually have a list. Many of you we've talked to who have cash. We kind of use a similar trigger. So if the trigger is to rebalance portfolios, and that's also a trigger to start to invest some of the cash. So I mean, we're getting pretty close. We've got a couple clients that were, dollar cost averaging where you're putting money in. So a client said, I want to invest whatever, just say $1 million. We typically look at where markets are, we look at recent performance, we look at valuations, and we'll say, like, now, I don't think I'd put it all into stocks, right? And so I think of two particular clients, we said, let's invest over the next 6 months. We'll put a little bit in each month, but with the caveat that prices, if they fall, we want to accelerate that. Well, so for those two clients, we actually, if the market ends up positive today, we're starting those purchases, so we are accelerating that. We just think the market has fallen enough now to be a little more attractive, right? You probably don't want to put it all in, but you want to start that process. Usually the 20% correction doesn't happen so frequently that you're like doing this every whatever month or two. It's kind of once every 3 years or so. So that's not a bad measure to start with. And I think historically, we've used that as roughly kind of as the initial trigger. But yeah, so we're getting pretty close to, if you have cash, it wouldn't be a bad time to kind of feed that in and begin that process, right? And so the other thing that matters too is what stocks you buy, right? So like the funds that we own I won't get into detail of that, but the funds all kind of do different things. So it depends on what you buy. And then one final thing that you'll see, and we looked at this today, and Brandon and I talked about it today. So one other opportunity that you have when prices go down, right, is to tax loss swap into new funds. So basically what that means is sell a fund, take the tax loss, okay, and then put it into something similar, right? And you put it into something similar, you take the tax loss, and you have to wait 30 days, but after 30 days, you can swap back into what you were in. We own some funds which are pretty generic index funds, and there are a lot of like reasonable substitutes for those. And in that case, it's a very simple decision. Some of the funds we own that are a little more complex, like a managed futures fund's pretty unique in its strategy, so it's hard to find equivalent alternatives. But we talked about some of the funds these are the wisdom tree funds, which we've bought for most of you over the past 6 months. Relatively large positions in the portfolio. Most of them are down now. So that's something that you potentially would see over the next few weeks, where we swap out of those funds into something new. We did this very aggressively back in 2020, and we're able to generate pretty considerable capital losses for clients without changing the character of the portfolio. And I think that's important from managing from a tax perspective too.
So one of the other ways, aside from just tax loss harvesting, for many of you, we've talked about Roth conversions over the last couple of years. I know I've talked with many clients about it in the last couple of months. There's typically 2 times that we would encourage doing a Roth conversion. Let me explain just generally what that is. So it's basically taking money from an IRA, traditional IRA, and converting it into a Roth IRA. Well, why would you do that? Well, one reason you may want to do that is because as that IRA, the traditional IRA, continues to grow, once you turn 72 and are required to take minimum distributions every year per the IRS, those amounts that you're required to take can substantially increase over time, which could also increase not only your tax burden, but also your potential premiums for Medicare. Well, one way to try to offset that for the future is to basically move from money from a traditional IRA into a Roth, pay the taxes now, and then put it in the Roth and let it grow tax-free. There's usually 2 times that we recommend doing a Roth conversion for those that it makes sense. One is towards the end of the year. Well, why at the end of the year? End of the year is because by then we have a very good sense of what your total income is going to be for that year. So we can project pretty closely what we need to help you convert from an IRA to a Roth. The other time that you may want to do it is like March of 2020, where the market fell 30%, portfolios may be down 10, 15%, somewhere in that range. And that's also a great time to convert money from an IRA, traditional, to a Roth. And the reason for that is, say you own a stock that's worth $100 and it falls to 70. Well, if you were to convert that $100 before into the Roth, you're paying taxes on that entire $100. Well, if you take that same stock, which we'd probably own anyway in the Roth, it's now worth 70. You convert it into the Roth, you're only paying $70 or paying taxes on that $70. And so it's a pretty significant benefit when the market drops to basically pay the tax up front at a depressed price, reinvest it or just journal it over to a Roth and pay the taxes on it now, but let that asset, if we're going to continue to hold it, just keep it in the Roth and let it grow tax-free. Then it comes out tax-free. And with a Roth, you don't have RMD requirements like you do with the traditional.
That's where we are here. Okay, we got time for another question. Anyone else? Great. Well, thank you all very much for coming. If you don't mind filling out your comment cards, and have a good rest of the afternoon. We appreciate everybody showing up today. Thank you.